understand. And if you and Hai want to kind of like.
Okay, so let's go ahead and get started. Today is January 30th, 2021. It's our 7th presentation for Wudang Investment Group. And today we are honored to have the partner from Anderson Tax, Ray Songson. That's how I pronounce your last name?
That's correct.
Okay. First of all, I want to thank Hai Tang again. He gave us a presentation last week on the company, Bitcoin and I think the business taxes, Bitcoin and business taxes, as well as the Biden tax reform. If you missed the presentation last week, feel free to go to our YouTube channel to listen to it. It's a great presentation. It has a lot of good information. For today's presentation, we will be focusing on taxes on your equity compensation. A lot of the people who work for public companies receive equity as part of their compensation package, and taxes on those equity compensation are complicated. There are articles and there are tax professionals who assist you with this, and I believe that's what Ray is specialized in, and that's why we asked him to give us a presentation. The purpose of this presentation is to train you on fundamentals of the equity, on the taxation of equity plans. It's not intended to answer everybody's question on the spot, because equity plans can get very complicated. Our goal is to help you understand the fundamentals so that you can continue asking questions in our WeChat group, which is the tax planning group, where Hai Tang is part of the group, and the group has been there for a few years. We have many tax professionals who work, who are part of either the national or regional CPA firms, or some IRS employees who are there to answer your questions for free. But our help in the WeChat group are by no means your final destination for equity plans, because I understand a lot of you guys are actually high up in the company that you receive complicated equity plans and you need professional help, and that's where Ray and his team comes in. So for that's the introduction for the group, for the presentation. And in terms of general disclaimers, for one thing, any advices that Ray gives or myself provides during this presentation, we are trying our best to advise you and answer your questions, but we don't hold ourselves accountable for what we provide you for. That's not to say that Ray is not professional enough to give you advice and release the disclaimer. It's just that it's a free consultation, so that doesn't constitute any legal liabilities or any tax professional liabilities. So understand that before you walk in the presentation and adjust your expectation. We will try to answer the questions that come in, but if the question is too complicated and doesn't apply to most of the groups here, most of the audience here, then we will skip that and you can follow up with Ray afterwards. Another point I would like to make before we move on is that if you speak up, actually let me take it back. All questions should come in chat form. I will be screening and filtering the questions that come in and choose the ones that apply to most audience to answer them. If you choose to speak, please be advised that we are recording this presentation, and the recording will be released and published on the YouTube channel. So before you speak, make sure that you are comfortable. Whatever that you talk about, it's okay for me to put on YouTube channel. It has happened twice now. For the past 6 presentations that people speak up and afterwards they ask to cut what they have said. It's okay to do that, and the only thing is that it takes a lot of time to do that, which I don't have and nobody has. And my goal is to release the presentation as soon as it's done so that people can watch it if they missed the live presentation. It has happened twice, and I'm not going to let it happen the 3rd time. If you speak, then you take the responsibility that you accept the release of whatever you said during the presentation. I will not be trimming down the presentation to cut the content that you shared during the group. And this applies to all future presentations. I may not remember to mention this every time, but this is a general rule of our presentations. With that, I will hand it over to Ray. Feel free to introduce yourself and then start the presentation. Thank you.
Thank you very much. Yeah, so my name is Ray Thornton. I am a managing director with Anderson. I am in the private client service group, and what that means is that we serve individuals. And so today we're going to be talking about taxation of equity plans, or also equity compensation. There really isn't there isn't a geographic area in the world that is better to learn about equity compensation than the Silicon Valley. I have spent the vast majority of my life living and working in the Bay Area or the Silicon Valley. In 2004, I was still a little younger in my career. I was a little bit involved with the Google IPO in 2004. I was much more heavily involved with the Facebook IPO in 2012. And you know, with Facebook, I remember when individuals at Facebook were first able to sell shares in the secondary market in 2009, and the Facebook shares at that time were at about a $3 value, and today they are over $250 per share. So they've gone up quite a bit. And so there's a lot of planning that could have been done around those shares. I was pretty heavily involved with the Twitter IPO in 2013. And more recently, I was pretty heavily involved with the Uber IPO in 2019. And so what happens is, you know, I get in front of a lot of these individuals that get issued stock options in the company, and all of those examples that I gave you, those companies reached very high valuations, right? And so when you have a situation like that, planning around your equity compensation becomes really critical. And you know, if you optimize properly for tax planning purposes, it could mean the difference, a tax difference of hundreds of thousands of dollars or even millions of dollars, depending on how you go about planning, implementing your plan. So. The learning objectives today is to have a better understanding of the various types of equity plans and the ramifications for individual income tax purposes. So these are the types of equity or share-based compensations that we're going to go over. I will tell you right now that I'm going to heavily emphasize the ones where we see the most of that I think are most appropriate. And those are going to be the non-qualified stock options, the statutory stock options, the incentive stock options, the ISOs, restricted stock, and restricted stock units. I will touch on ESPPs and stock appreciation rights, but I will really go much more in depth on the other ones, primarily because those are the most common ones that we see. And those are the, what I think are the most relevant. So first of all, we want to start by sort of defining some terms here, right? So, you know, a lot of times in my experience, you know, a lot of the workers at startup companies, many of them are right out of college, right? And so they sort of get issued these stock options, and, you know, something's being offered to them and they say, sure, it sounds great. But in many ways, they don't really truly understand what they have, right? And at that point, you know, until it actually really starts to appreciate and value, they don't really kind of view it as a serious thing, right? Like, you know, they just kind of figure at some point they may need to know about it. So a lot of people who get issued these options are not even sure what they mean. So hopefully I will be helpful in sort of defining what some of these terms are. So when we talk about a stock option, when someone is issued stock options, what they are being issued is a right to buy shares of stock for a specified price within a specified period of time, okay? So it's your option, right? Like, so if a stock option is issued, at some point, you could choose to exercise that or not. It's really up to you, okay? And we'll get into kind of how you know, what are the taxable events, you know, what's the timeline for taxable events with stock options. The grant or exercise or strike price all referred to the specified price for which a share can be purchased by using the option right or exercising the option right. So when we talk about an exercise price or strike price or grant price, what we're saying is you have the option to buy these shares. It's going to cost you X number of dollars, right? So that's the strike price. The way to think about it is when those options are issued, they have to be issued at fair market value, okay? And so the strike price has to be issued at fair market value, okay? The hope is that, you know, fair market value today is very low relative to what the fair market value is down the road, okay? But again, the strike price is the amount of money that you have to come up with to be able to exercise and acquire the shares pursuant to the option. Vesting. So when a right becomes, vesting is when a right becomes forfeitable because certain conditions such as a continued employment have been satisfied. The most common vesting provision by far is just a time vesting provision. And what it is it's a 4-year vest, okay? And what that means is that, and it's a 4-year vest with a 1-year cliff vesting, okay? And I'll explain what that means, is that what happens is if on January 1st, 2021, someone was issued options with the standard 4-year vest, and let's just say there were 100,000 options issued, okay? So, and it's a 4-year vest. So what happens is the first 25% do not vest until you hit the 1-year mark. And that's what they mean by cliff vesting is you have to get to the 1-year mark before anything will vest, okay? And so what that means is that if you are issued options, you're granted options, and you choose to leave before 1 year, in my example, you're granted 100,000 options, you vested in nothing. So you have no right to exercise anything because you didn't hit the 1-year mark. If instead you hit the 1-year mark, you vest in 25,000 shares or 25% of the total, okay? That doesn't mean you have to do anything. It just means that those are yours to keep, even if depending on the company policy, even if you leave the company. And so, and then what happens in the standard 4-year vest with a 1-year cliff is that after you hit the 1-year mark, you then vest on a monthly basis. And the amount of shares that you invest on a monthly basis is 1 divided by each month you invest in 1 divided by 48 months, right? So in this case, it would be 100,000 divided by 48 months. That's the number of shares you would vest in on a monthly basis, such that when you get to when you finish your 4th year, all 100,000 options would be vested to you. Okay. Again, it doesn't mean you have to do anything with it. It's just that you will not lose those if you leave the company once you vest in them. Okay. Vesting is a very important provision that people have to really understand. What is exercise? Exercise is the act of using the option right to purchase the shares at the specified price. Okay, we're going to get into the taxation of it later on. At what point do you have taxation? But when you are viewed to exercise the options, what that means is you've taken money out of your pocket. You've gone to the company and say, I want to acquire these options. Now, looking at the term above it, you will, in most cases, you will have had to vest in those options. There are some provisions in which employees may be allowed to early exercise. We're not going to get into that too much right now, but for the most part, you have to have vested in your shares, and then you can choose to exercise them. So we're going to start with non-qualified stock options, okay? NQSOs are an award that allows the recipient to acquire shares of company stock by paying an exercise price, okay? The exercise price is generally the fair market value of the company stock on the grant date, okay? And so if you imagine a company very, very early on in the life cycle, a company that maybe has only raised seed funding or maybe a Series A, in theory, that value might be very low. And so the exercise price on those options might be very low. The hope is that the exercise price is as low as possible, and that down the road, by the time you're able to exercise and sell those options, that the value is as high as possible. Okay, that's really the hope with anyone who's being issued options. Okay. NQSOs can be exercised over a specified period of time. In my, I've covered the vesting provision. In my experience, the typical kind of time period for an option is that it expires 10 years after it was granted. That's typically what we see. So something to kind of keep in mind. You might be in a position, if you get to that 10 years and you haven't exercised, you might have to do something with it. Either choose to just forfeit it, let them expire, or choose to exercise. I'm sorry, is there a question? Okay. Subject, and then NQSOs are typically subject to a vesting schedule and cannot be exercised until they vest. So as I talk about the taxation of NQSOs, it's important to keep these in mind. And when we get to incentive stock options or ISOs, it's important to distinguish them, right? I'm going to cover NQSOs on this slide, but I am then going to talk about ISOs and kind of differentiate them and explain to you why one is much more favorable to the other. So when the stock options are granted, that's not a taxable event. As I said earlier, you could be granted stock options, but it's ultimately up to you whether or not you want to exercise those options, okay? The granting of the options is not the taxable event, okay? When you do choose to exercise the options, you will recognize ordinary income, which is treated the same as wages, equal to the fair market value of the stock on the day of exercise minus your exercise price, okay? So let's just say well, actually, we're going to get into the example, so I don't need to get into that. But keep in mind, I do want to clarify a term here. When we say ordinary income, we mention ordinary income in the context of if you get long-term capital gain holding period on an asset for U.S. federal tax purposes, that gain is subject to a lower tax rate than on your ordinary income. Okay. Currently, the ordinary income is taxed at a top rate of 37%, whereas capital gain could be as much as 20% plus 3.8%. Okay, so 37% versus 23.8%. So ordinary income is typically going to be wages, it'll be interest income, non-qualified dividend income. Okay, so when you exercise options, you have ordinary income equal to the difference between the fair market value of the stock less the exercise price. Now, if you exercise these options and the company is private, then at the time of the exercise, the fair market value will typically be whatever the 409A is in place at the time of the exercise. If the company is public at the time of exercise, fair market value is going to be whatever the stock is trading at when you exercise. Okay, so keep that in mind. This is a huge part of this next thing is a huge part of NQSOs, and that's at exercise. You are subject to applicable federal, state, and FICA tax withholdings. FICA is essentially it's Federal Insurance Contributions Act, also referred to as Social Security. And so this is a really big part of NQSOs, and it's a reason why you don't see a lot of situations where once the options have appreciated in value and they have a value that's high relative to the exercise price, you don't see a lot of situations where someone is going to exercise and hold their NSOs. And that's because not only do they have to come up with the exercise price, but they also have to come up with the related tax withholdings, okay? And we'll get into that in an example. So in a year of exercise, the difference between fair market value and the exercise price is reported as wages in your Form W-2, okay? And then there's some more specific reporting there in box 12, code V in the Form W-2. One thing I want to mention, not sure how many people this might apply to, but if you are a contractor performing services, you can be issued non-qualified stock options, okay? And in those situations, when you exercise, because you're not an employee, there are no required withholdings. So instead of if you're an independent contractor and you exercise options, difference between fair market value and the exercise price will actually be self-employment income. Okay, so that's just something to keep in mind, and it will not be subject to withholding requirements because you're not an employee. Okay, so the cash flow considerations here are, if you are going to exercise and hold, you're going to have to come up with both the option price and the applicable tax withholdings. I can tell you that in most cases, non-qualified stock options are exercised and sold in what's referred to as a same-day sale. And we'll get into an example later on, in which case you don't even take money out of your pocket to exercise. You just basically get the net proceeds after accounting for the exercise price and after accounting for the withholdings, both of those being subtracted out of the proceeds from the sale of the stock, okay? And then, but if you did exercise and hold, then at sale, the capital gain on your sale of shares would equal the sales proceeds minus your basis. And in this case, your basis would be exercise costs plus any ordinary income that you reported at exercise. So here's an example. Exercise and hold and subsequent sale, okay? So granted 5,000 NQSOs in January of 2017, exercise price is 1,000, okay? So we know that the exercise price is $5,000, right? 5,000 times 1. Exercised 1,000 vested NQSOs in February 20 when the fair market value is $25 per share, okay? And then sold those same 1,000 shares more than 1 year later at $40 per share, okay? Tax impact. 2017, when the options were granted, I mentioned this before, no tax impact when they're just granted, okay? In 2020, the year of exercise and hold, you have ordinary income on a per share basis of $25 fair market value, less the exercise price of $1. So that's $24 per share times 1,000 shares is $24,000 of income. So as mentioned in the prior slides, you would have to come up with a dollar exercise price per share. So that's $1,000. In addition to that, you would have $24,000 of income. Therefore, you would have to come up with the required tax withholdings on $24,000 of income, okay? And then in the subsequent year of sales, since you held it for at least 1 year after exercise, you get long-term capital gains. And so your gain is the $40 per share sales proceeds, okay? So $40,000 less the basis, not of, 1,000 shares, which is just the exercise price, but it's the 1,000 shares plus the $24,000 that you recognize as ordinary income. So total basis of 25,000 shares, such that your capital gain is $15,000, right? Only the amount that exceeded the 25,000, which is the value that you took in the ordinary income, will be capital gain to you. So this is what I was talking about before. So if you did a same day sale, okay, what that means is in this case, you have 1,000 shares, okay, and you just sell it for $25,000 $25,000 total proceeds, or $25 per share, okay? That results in income of $24,000, okay? So what happens is you don't even have to come out with that dollar per share exercise price. You just get the net number. So what does that net number look like? Well, there has to be withholdings for for federal purposes, so 22% on the 24,000. There's also got to be Social Security withholding, and there also has to be California withholding as well. So you take all those amounts, just kind of chip away at your proceeds, such that you end up with this net number after the exercise costs and after the withholdings. A good rule of thumb for someone, we're here in California, so someone who's a California taxpayer, is that, if you have ordinary income, you're probably going to pay about 50% on your ordinary income. So if I'm exercising and selling options that result in $1 million of income, then at the end of the day, when you kind of subtract out exercise price and you kind of subtract out, the withholdings, you should end up getting, in my example, if you have $1 million of income, you should end up getting about $500,000 of cash in your pocket at the end of the day, which, should roughly, cover what your ultimate tax liability may be. One thing I do want to note is, see how the federal withholding is at 22%? You could find yourself in a situation where the withholding is at 22%, but the actual tax that results from the exercise could be taxed at a higher rate, okay? It could be 30, it could be as much as 37%. As a result, if you just assume that the taxes that were withheld on that would cover your tax, you're unfortunately going to be mistaken, okay? And so that's something to look out for. On the other hand, you look at the California statutory withholding rate of 10.23%. It's possible that you may not have that much income in a given year, and your tax ends up being lower than the 10.23%, in which case you should get some of that refunded. Okay, I said earlier that it was going to be important to sort of distinguish non-qualified stock options with incentive stock options. So in general, incentive stock options are much more preferable than ISOs, and we're going to get into why. ISOs are the same as NQSOs, but are subject to limitations. Grant restriction of $100,000 in fair market value annually, and basically what this is only $100,000 option ISOs can be exercisable in any given year. If you end up going over that, they haven't met the ISO requirement, and therefore they would be treated as non-qualified stock options, okay? There are exercise limitations around termination of employment. So what typically happens is if you have vested in your ISOs and you leave the company, you typically have 90 days to exercise those ISOs. If after those 90 days you haven't exercised those ISOs, you either lose those options or those ISOs get converted to non-qualified stock options. Bottom line is, you know, if you've left the company, you really, for a prolonged period of time, they can't remain in ISOs. The other thing to consider is that I mentioned earlier, if you had an independent contractor who was issued non-qualified stock options, only employees of the company can be issued ISOs, okay? And then there are some holding period requirements that we'll get into as well for ISOs. So the key planning around ISOs is the difference between a qualifying disposition and a non-qualifying disposition, okay? A qualifying disposition, it happens if the stock is held for the required holding period of 2 years from the date of grant and at least 1 year from the exercise date, okay? And we'll get into an example. A disqualifying disposition is if the stock is not held for the required holding period, meaning if options were exercised and then sold within before the 1 year anniversary of the exercise, or if they were exercised and sold within the 2 year anniversary of the grant date, okay? That would be a disqualifying disposition, and we'll get into how that works, okay? So the taxation of ISOs are actually a lot more complicated, but could be a lot more beneficial to an individual. When one exercises an ISO and holds, there are no quote unquote regular income tax consequences upon grant or exercise, okay? And at exercise, the difference between the fair market value and exercise cost is income only for alternative minimum tax purposes, okay? I'll just quickly kind of explain that the AMT, or alternative minimum tax, is really a parallel tax system that you have to compute in addition to the regular income tax system, and you pay whichever is higher, right? So if you exercise and hold ISOs, what happens is the difference between fair market value and exercise cost is income only for AMT purposes, okay? Another really big benefit of ISOs is that when you exercise, there's no federal, state, or FICA tax withholding requirements, okay? And so, as I said earlier on NQSOs, if you exercise and hold, not only do you have to come up with exercise price, but you also have to come up with required withholdings. For ISOs, all you have to do is come up with the exercise price. That gives you a lot more flexibility around the exercise of ISOs, okay? Assuming you have met the required holding period for qualifying disposition, what that means is that at the sale, you get long-term capital gain treatment equal to the difference between your proceeds and your cost basis. So for regular tax purposes, your cost basis equals exercise cost. Why is that? Because remember, when you exercise them in the first place, there was no regular tax impact on the ISOs. There was just, there's nothing to do for regular tax purposes. However, for AMT purposes, your basis gets stepped up to the fair market value at exercise because you recognize the difference between fair market value and exercise costs for AMT purposes at the time of exercise, okay? So again, and we'll get into an example, but if you're gonna exercise and hold ISOs, you're really looking to do a qualifying disposition, okay? If for some reason you get caught, something unexpected happens and you have to have a disqualifying disposition, then what happens is rather than getting the long-term capital gain treatment, you're going to have ordinary income treatment. Okay, and so that's something to keep in mind. You generally want to avoid that as much as possible. Okay, so if you exercise ISOs in a given year, very important that you make sure to get from your employer Form 3921, which reports the exercise of ISOs. Okay, and so make sure that, if you prepare your own tax return, you account for that, or if you use a tax preparer, make sure that you get them that form. It's very important. So here's an example. We're going to do first a qualifying disposition. So granted 5,000 ISOs in January of 17, exercise price of $1 a share, exercised 1,000 options in February 20 when the fair market value was 25, and then sold 100 shares in March of 2021 at $40 a share. In the 2021 sales proceeds is $40 a share. I apologize. It should say sold 1,000 shares in March of 2021. So that's a typo there. So it should be exercised 1,000 options and sold 1,000 shares. So the proceeds will be 40,000. Okay. The exercise cost is 1,000 for regular tax purposes. Okay. So your long-term capital gain is $39,000, which is 40,000. Sales proceeds less your exercise price, right? It's important to understand that the benefit of exercising and holding and getting long-term capital gain treatment is that $39,000 gain is going to be subject to the lower capital gains rates of about 23.8%. Had you not exercised and held those options or held those shares to get long-term capital gain treatment, then all of that appreciation at up to $40 would be ordinary income. So instead of paying tax at 23.8% for federal purposes on 39%, you may be paying tax at 37% as ordinary income on the sale. Because now for AMT purposes, your capital gain is actually less, okay? And the reason that is because in 2020, when you exercise, you recognize up to $25 of per share of income. Okay, so in effect, you have a different cost basis amount for AMT purposes because you accounted for it in the year of exercise. So you get to effectively reduce your regular tax gain of $39,000 by what you previously recognized, which is $24,000, right? So that's why you have an adjustment of an adjusted capital gain of $15,000. Now we're going to deal with the same example, except have a disqualifying disposition, okay? So what happens there is in 2021, instead of getting long-term capital gain treatment, you have disqualifying disposition equal to the fair market value less exercise price. The fair market value at the time of exercise is 25 minus 1 is $24,000. That's ordinary income. Because you actually did still have some appreciation after your exercise, you actually do get capital gain treatment, but because you didn't hold it for at least a year, that capital gain treatment is not long-term capital gain subject to the lower tax rate, but short-term capital gain, which is taxed at the same as the ordinary income rate, okay? So it's just as bad as being taxed on the wages, and so you would have short-term capital gain equal to the amount above the value of which you exercised. So again, I want to emphasize that if you're going to exercise ISOs, then you really want to try to pursue long-term capital gain treatment, holding it for at least selling it for later than 2 years after grant and later than 1 year after exercise, because that's when you get the big tax benefits. And if you have a disqualifying disposition, the tax result is generally going to be a lot harsher. Now you might find yourself in a situation where you want to intentionally do a disqualifying disposition, because let's say in this example, when you did in February of 2020, when you exercised 1,000 options, $25 a share, what if the stock tanked by the end of 2020 and it was at $5 a share? Like, in that scenario, you would probably want to sell the shares in a disqualifying disposition, because that would limit the amount of income you'd have to take into account. In that example, you would only have to take into income the $5 less the strike price of $1 or $4 per share. Employee stock purchase plans. As I said at the outset, there were a couple topics I was going to cover pretty in depth, like NQSOs and ISOs, and some that I weren't going to cover too much. So this is one where I'm just going to kind of go through the slides, and not something we see a ton of in the Bay Area, but something that comes it comes up every once in a while. If there are questions on ESPPs that I may not be able to answer, I'm happy to kind of track that down, maybe follow up. But what happens with ESPPs is the company withholds through payroll deductions, and those amounts are used to purchase stock in the company, right? And you typically get up to a 15% discount to the fair market value of those shares. Okay, so what we're typically dealing with here is with the company's already public. Okay, and so basically the discount ends up being sort of ordinary income to you. You have to recognize it. But if you are able to acquire the shares, a similar concept here with qualifying disposition. But if you're able to acquire shares and get the long-term capital gain treatment, you can really benefit from the lower capital gain rate. Taxation of ESPPs, qualifying disposition, you'll have ordinary income equal to the lesser of the grant date discount or the sale price less purchase price. So you can see where, you're typically going to take into ordinary income the grant date discount, with the only exception if the stock actually goes down and the sales price less the purchase price is actually less than the discount. Okay, and then you will recognize capital gain equal to what you eventually sell it for, minus your purchase price plus what you recognize as compensation income. With a disqualifying disposition, you have ordinary income is equal to purchase date discount, and then capital gain is sales price minus purchase fair market value. Okay, and then no federal, state, and FICA tax withholdings. And ISOs are reported on forms 3922. 3921, as I said before. ESPPs are on form 3922. What I didn't sort of mention before, I sort of did mention, but you might say, well, what are NSOs reported on? Well, they're reported on the W-2. Okay, so if you have exercise of NSOs, whether you exercise and held or exercise and sold, they will be reported on a W-2, or if you're a contractor, on a 1099. Okay. The reason why ISOs have a form requirement like form 3921 is because they don't count for regular tax purposes, right, when you exercise and hold. So if they weren't reported on form 3921, the IRS would not know about it, right? And the reality is form 3921 only really kind of came about in the last 7 or 8 years. Before that, the IRS really had no way of knowing whether someone exercised ISOs or not. So this is, I'll just give you a second to kind of look this over. This is how ESPP example works. As I said earlier, if there are questions about ESPP, I'd be happy to kind of track them down. It's just not something that I have a ton of experience with. Similarly here, stock appreciation rights is not something we see a lot, other than, these are typically seen with companies that are already public, and the company doesn't want to go about issuing options or issuing RSUs, which we'll get to in a second. And in effect, they just grant someone the appreciation rights to the underlying stock, okay? So participants are granted a right to a cash or stock payment equal in value to the difference between fair market value of company stock on the grant date and the value of the SAR exercise date. SARs are exercisable over a specified period of time. In a year of exercise, they are reported as wages. The taxation of SARs are no federal, state, and tax withholdings at grant. At exercise, applicable to, subject to applicable federal, state, and FICA tax withholdings. At exercise, ordinary income equal to the fair market value at exercise minus the fair market value at dated grant. Okay. Restricted stock is something that you're going to see, you'll typically see very early on in the life cycle of a company, okay? Participants are awarded shares of company stock subject to restrictions on continued ownership, such as a requirement that the participants remain employed by the company for a set period of time. Restricted stock are treated as issued and it's outstanding on the award date. Participants have applicable voting and dividend rights on those shares, okay? So basically restricted stock is like, here are shares, we're just gonna grant it to you, right off the bat. Now, we may have some vesting provisions, but these are restricted stock. So they're not options, right? You don't have to exercise, you don't have to come up with an exercise price. They're just shares. Now, a big difference between restricted stock and stock options, whether they be ISOs or NQSOs, is that with options, there is no taxable event upon grant, okay? Because you haven't exercised them yet, okay? Restricted stock is different, okay? Restricted stock is, here is $10,000 worth of restricted stock, okay? The way it works is that if the restricted stock is subject to vesting provisions, then technically you're not taxable on the amount until you actually vest, okay? So let's say restricted stock was issued $10,000 of value, 1 year vest, okay? So if you stay 1 year, you vest in the entire amount. Let's say the $10,000 is $50,000 in 1 year, okay? That's the 50,000 is the value that you would recognize once you vest if you don't make an 83B election, okay? If you just don't do any 83B election and get issued stock, when you vest, if it's worth 50,000, doesn't matter what it was issued at, it's just a matter of what you vested in, right? An alternative to that, and generally much more preferred way of going about things, is making an 83B election. And what that simply means is that you're telling the IRS, I want to be viewed as acquiring this stock today for tax purposes, okay? And what the effect of that is that the value, as I said earlier, upon grant was $10,000. By making an 83B election, you say, I know I haven't invested in these shares yet, but I want to recognize the income as if I have. So I'm going to take into income the $10,000 and I'll have to pay tax on that. The big benefit of that is down the road, if it has appreciated to $50,000 and you've held it for at least a year, then guess what? You've got long-term capital gain treatment, taxed at a lower rate, okay? So whether you vest, whether you wait till you vest or you make an 83B election, if you have ordinary income from the grant of restricted stock, it'll be reported as wages. So I mentioned this on the prior slide, but again, no tax impact upon grant without an 83B election. at vesting date, ordinary income equal to the fair market value of company stock, and at that taxation date, subject to the various withholding requirements. 83B election, it must be made within 30 days upon the transfer of unvested stock, okay? If you're gonna make the 83B election. This, I can't emphasize enough how critical the 83B election is. In my example, you could see where you're so much better off if you just take into income $10,000 if you know it's gonna be $50,000 the next year, right? But that only happens with an 83B election. So you have to send that off to the IRS within 30 days upon the transfer of invested stock, okay? What if you make the 83B election, then there's no tax impact upon the actual vesting, because the whole point of the 83B election is that you choose to recognize the income and treat it as being acquired at the grant date. Okay, therefore the vesting doesn't matter anymore. The next taxable event will be when you actually sell those shares. Okay. So this is an example of restricted stock where you are issued an amount of restricted stock. And, you know, if you make an 83B versus, you know, taxpayer A makes 83B election, taxpayer B does not. So you could see on the grant date, when a taxpayer A makes 83B election, so they recognize the fair market value of stock on that grant date, which is $300,000 of income, okay? For taxpayer B, no ordinary income because they haven't vested yet and didn't make the 83B election. On the vesting date, since taxpayer A made the election, they don't have to recognize anything. However, taxpayer B did not make the 83B election, so on vesting, they are taxed at the value at the time of vesting, which is more than double what taxpayer A had recognized as income. And then they both sell it for the same price down the road, but you can see where taxpayer A got much more favorable tax benefits by making the 83B election than taxpayer B. Restricted stock units. So I would say restricted stock units are a really, really popular form of equity compensation. At a certain point, what we see is companies stop, when a company gets big enough and they're public, or maybe even before they've gone public, they might stop issuing stock options. And part of that reason may be when you issue stock options as a private company, you have to come up with the value of the strike price of those options, which equals the fair market value at the time they're granted, right? Well, in order to determine what the value is, you have to obtain a valuation, right? So with RSUs, you don't have to get a valuation for shares. All an RSU is just their participants are granted the right to receive a stated number of shares of company stock at some future date. No 83B election is available, so there's just no planning that you could do around that with the 83B election. In the year of vest, the value of the vested RSUs are reported as wages, okay? Upon the grant of RSUs, there is no tax impact, okay? So it's important to, let me just, okay. One thing that's not on the slide, but I think is very important. The way to think about RSUs is they have what's typically referred to as the double trigger vesting, okay? So for the first trigger, as I mentioned before this, let's just say it's the standard 4-year vest, okay? So that might be the first trigger, right? So after 4 years, you have fully met the first trigger, okay? But because these would be paid out as shares, if the company is still private at the time of the vesting, you know, there's really no public markets or any liquidity to be able to grant those shares, right? As a result, the second trigger is usually revolves around either a sale of the company, where it is sold for cash, or around an IPO, okay? So typically the second trigger on RSUs is actually 6 months after an IPO, okay? Facebook went public in May of 2012. So by that point, a lot of the individuals had vested in the first trigger on the RSUs, but they didn't fully vest in the RSUs and have it be taxable until November of 2012, which was 6 months after the IPO. And that 6 month period is the typical lockup period you have where shareholders are, prohibited from selling shares in the public market. So that's an important aspect of RSUs. So at vest, whatever the value of your RSUs will be, which is just the price of the shares, will be ordinary income to you, and it will be subject to the various withholdings. The withholdings are due when the shares are transferred, and the tax can either be paid by cash or check, or the company can withhold enough shares to cover tax withholdings, okay? So just kind of a simple example, if you are due 100,000 RSUs and you hit your second trigger, what typically happens is you might end up receiving about 60,000 shares, okay? And the reason that is because you're gonna have required withholdings on that income. So if you had 100,000 RSUs and they vested at $10 a share, that's $1 million of income, okay? Well, you have to withhold taxes on that $1 million of income. So the reason you might have only received 60,000 shares instead of the 100,000 is because they had to sell 40,000 shares to cover your required withholdings, okay? And then if you hold on to your shares for at least a year that you got from your RSUs and then sell them at a gain, then you might be able to qualify for long-term capital gain as long as you held it for at least a year after the double trigger vesting. So here's an RSU example. So our number of RSUs, 30,000. Fair market value stock on grant date is $10, but we don't care about that. Fair market value on transfer date is $30, okay? That's the relevant thing here. So on the transfer date, the income will be $900,000, subject to various withholdings, okay? If you then sell it down the road and you've met the 1 year holding period, then you get long-term capital gain on the appreciation above the $30 per share that you recognize the income on the transfer date. That's all the material I have. I think we're ready for Q&A.
That was a lot of material that you covered. Thank you very much for doing that. Actually, the audience has been awfully quiet today. I don't have any questions coming in. Okay. I guess that means that,
fine.
Yep, yeah, I guess that means you did a perfect job explaining the material. So I have a question myself. Can you explain how AMT kicks in when people exercise the options?
Yeah, so here's, first of all, here's the way to think about AMT, okay? So how you think about AMT, first you have to think about regular tax, okay? So for regular tax, let's say someone has $200,000 of wages, okay? And let's say they have some deductions, mortgage interest, and say they have $200,000 of income, and let's say they have let's say $20,000 of deductions, okay? So now that their taxable income is $180,000, right? So 200,000 of income minus their tax deductions of 20,000. And so you have income of 180,000. So then you apply the regular tax rate tables to that tax, and you might come up with, let's just call it $50,000 of tax on $180,000 of income, okay? The way AMT works is AMT says, okay, start with the taxable income under the regular tax, and you have 180,000 taxable income. But you know, maybe of the $20,000 deduction that you got for regular tax purposes, 10,000 was for property taxes. Okay. Well, you don't get to deduct property taxes for AMT. Okay. So for AMT purposes, you have $190,000 of income because you had to add $10,000 back. And then what happens for AMT, you actually have a flat rate, unlike regular tax that has a progressive tax rate structure. The more income you have, the higher the tax rate. AMT is just a flat 28% rate at the federal level. Okay, so then you calculate your tax on the AMT. And then you compare the two, right? And so if your AMT calculation is higher, by definition, you're in AMT, okay? So if the way to think about being an AMT versus not being an AMT, for regular tax purposes, the top rate is 37% on ordinary income. So let's say someone has $5 million of ordinary income and no other type of income, okay? The top, then their effective rate on that will be, you know, about probably the top rate of 37%. So whatever 37% of 5 million is, that will be roughly the regular tax liability. For AMT purposes, assume no deduction, so same $5 million, but as I said earlier, it's just a flat rate, right? And so 5 million times 28% instead of 37%, right? So that's your AMT tax. So in that example, you're not subject to AMT. That's because you had all this ordinary income that's taxed for regular tax purposes at a much higher rate than for AMT purposes. In that scenario, if you have incentive stock options that have appreciated, then you have an opportunity there to be able to exercise and hold those ISOs. And the reason is that you are some amount of tax out of AMT because your regular tax is so high. What that means is you can exercise and hold ISOs and recognize income for AMT purposes only, and it may not produce any incremental tax because you're way out of AMT. Now, if you exercise enough, it could put you into AMT, but that's just something that you can kind of plan around and do some sensitivity analysis, because when you exercise and hold ISOs, the difference between fair market value and exercise price is taxable for AMT purposes only.
I think that's the part that I always get confused on. First of all, AMT is not an easy thing that you can forecast and analyze until you really do your tax return. Is that true?
That is correct. But yeah, but you have to kind of have a sense of where you think you're going to be. If you know you're going to have a bunch of ordinary income, it should provide an opportunity. One thing I'll say is that starting with the 2018 tax legislation that was enacted in December of 2017, but didn't take effect until 2018, the changes that took place into the 2018 tax bill resulted in a greater chance that someone would not be subject to AMT. So that's just, and that provides more opportunities on ISOs to be able to exercise and hold. And a big reason why they did that is because they took away some items that would normally be subject or tax deductible for regular tax purposes, but not for AMT. For regular tax purposes, they took them away as well. So you have a much less chance of being an AMT starting with 2018.
Oh, that's good to hear, because yeah. I feel like a lot of the families in Silicon Valley, they can easily hit AMT, and AMT is a miss to me all the time.
Well, but I would say this, yeah, generally you want to avoid being out of AMT. However, if you're in a situation where you know you're in AMT, and let's just say you have some amount of income that you can kind of control the timing on it. As I said, if you're in AMT, you know, the top rate on ordinary income is 28%. It's a flat rate. Versus if you're out of AMT, it's 37%. So you could find yourself subject to AMT, and you have some amount of ordinary income that you know you're going to recognize at some point, you can control the timing. You might choose to do it when you're actually in AMT because it will be taxed at 9% less. So.
Okay, got it. So there's a question that came in. I'll just read the question. Is it advisable to sell RSUs as soon as they are vested? How about ESPP? Or is it better to hold for long-term capital gain?
Yeah, I think this probably holds the same for ESPPs as RSUs, but I'll primarily address the RSU side of it. Here's one way to think about it. Facebook went public in May of 2012 at $38 a share. By the time the second trigger happened in November of 2012, 6 months after the lockup, the stock price had gone down to the low 20s. Okay, so let's assume it was $20 a share, right? It was more like 23, but just for simplicity, say it was $20 a share. So today, Facebook is trading at over $250 per share. So it wasn't that long ago. It was like 8 or 9 years ago, but probably not too many people who vested in those RSUs and then held for that long, but it recovered pretty quickly, right? So it was kind of a double benefit, right? Like, let's just say Facebook had done really well after the IPO, okay? And it went from 38 to, let's just say 70 by the time the double trigger happened. Well, guess what? That 70 is subject to ordinary income and the ordinary income tax rate, right? So you ended up having to, take into income $70 per share of income, right? And then maybe you hope for appreciation. But in this case, let's say, it was in the low 20s. So let's say it was $20. Well, you pay tax on $20, but if you held on to your shares, and quite a few people did because they thought it was going to recover, your cost basis was $20. I know some people that sold for, over 100, right? Like after a year, and they got long-term capital gain treatment on the appreciation above 20, right? So, but then I feel compelled to say the flip side of that is when Zynga went public in December 2010 at $10 a share. And it didn't go much higher. It pretty much went down after that, right? So that's kind of the opposite side of the coin, right? Like it comes down to, a couple things. Number one is if you have a bunch of other shares in the company, you might feel you have sufficient exposure already that you may say, I don't need more exposure by having more shares. And then the other big part of it will be what's your outlook on the stock. If you get it at $20 per share, but you think it's going to be 100, you should hold it. If you get it for $20 a share and you think it's going to be 10, you should sell it. So.
Well, you would, let's just say this: you would be extremely rich if you know for sure, right? The stock price, because I think Uber employees got really screwed up.
Yeah, they had kind of the timing was not very good with Uber, and so it's recovered a little bit, and then they did some kind of funky things with their IPO, and they withheld. I think they withheld or they recognized it at the IPO price and not 6 months later. So.
Okay, next question. Any new law related to options for our 2020 tax returns that we should be aware of?
No, even with the 2018 tax bill, other than taking away certain deductions which impacted the regular tax AMT, there really weren't any changes to options. Now, might we see some changes, starting with the 2022 tax year with the new president? Possibly, but no, there really no changes.
Great. And Haitang mentioned last week during his presentation that if there are new laws that Biden signs in 2021, most likely it's going to start next year, not this year, right?
That is correct. That's our understanding.
Okay. So we don't have more questions from the audience at this moment, and I'm just asking questions as they come to mind, or it's more of a chat. Just to explore the topic a little bit more, if you don't mind. And then for everybody who is on the presentation, if you have questions, feel free to ask, and you can ask your question in Chinese, and I will translate it. Just don't feel shy to ask questions. Ray is here to help and answer all the questions, and I'm sure, as you can tell, he's an expert in the field. So don't lose this opportunity to ask your questions for free. I'm going to rephrase my comment in Chinese, Ray, if you don't mind.
Sure.
是这样哈，今天呢，我们请到这个Ray， 他是Managing Partner at Anderson， 那他跟唐海一样，也跟我们的海哥一样，也是billable rate after discount 是600块钱1个小时的哈，所以呢，大家有这么一个opportunity， talk to a managing partner at Anderson about your questions on equity plan， 大家不要 lose 这个，就是不要浪费这个大好机会哈。Any questions you have on your equity plan， 都没关系的。它 cover 了很多 material。说实话，刚才我也是在 multitask， 我也没有听得非常的清楚。那如果说你有问题的话，no question is dumb question， just ask， feel free to ask， and you can ask， 就是说你就用，你如果觉得说用英文问不太好的话，就用中文问，然后 Ray 回答了以后，我也可以就是帮大家 translate。这个 area 其实是就是蛮 complicated 的。很多人包括我们做财务的，有时候都不知道应该去怎么弄那个option 的 tax。然后呢，我前一段时间拜读了一篇公众号文章，是那个就是辣妈，好像什么花街辣妈吧写的。我为什么会做这个讲座呢？就是因为那个花街辣妈的辣妈的那个公众号文章写的呢，其实有一点就是怎么讲呢？是鳌头那样子，把这个 stock option tax 说的非常的就是非常的好像第一当然是 complicated， 但是第二呢，有一点耸人听闻的。我记得那篇文章，当时我们的副群主 Grace 转在群里的，因为他也是为我好嘛，就转了for my information。然后我一看，他其实是就是说说了一半没有说一半，然后呢说的那一半呢又说的特别吓人，就是让大家觉得说这个东西好像就是高不可攀，一定要去找tax professional 来做这样子，但是实际上不是这样的。我的 tax return 我一直都是自己做，而且这个我不觉得说需要非常就是 profound information profound knowledge so that you can do it yourself. So Ray, actually what I'm trying to explain to the group is that first of all, no question is dumb question. Even if people ask something that you have already presented, I'm sure you're happy to answer them, right? Sure. And then the second thing is I'm actually a firm believer of doing your own tax return if you can. The reason being that most people's tax return is not that complicated, right? You have software, and then you can pretty much punch in the numbers and do your tax return. And I promote self-prepared tax return mostly because that's a venue for people to really force themselves to learn about the tax knowledge, right? Otherwise, you probably won't sit down and then listen to a presentation or read some material on stock option tax. So I think and that's why I actually have a WeChat group where Hai Tang is in the group answering questions for free. And that's how I feel like people should learn about the fundamentals of their income taxes before they can start planning on it. To me, the essence of the tax field is on the planning part, is not on the tax filing part. And I'm pretty sure that you agree with me on that, right?
Yes,
that's where you guys come in, and that's where most of your values are. So let's see. I think as we are speaking, there are questions coming in. I'm going to read them, and hopefully, I mean, whether you have presented it or not, I hope that these are questions that worth your time answering. First of all, can you please explain a little bit more about AMT income? What's the difference between AMT income and ordinary income? Is that part of the ordinary income? Not sure in what situation I would get AMT income. Thank you.
Yeah, I would say this. The way to think, it's not so much AMT income versus regular tax income. It's, you know, what items are taxable for regular tax and not for AMT, or maybe taxable for AMT and not for regular tax, and what items are deductible for regular tax and not AMT. So the biggest issue that we see here for, say, a California taxpayer is that for regular tax purposes, state income taxes are not deductible, right? So for many clients that I have, that could be one of their biggest deductions, is how much they're paying to the state of California, state income taxes, right? And so that's a really big deduction. So that used to be deductible for regular tax purposes. Now, starting with 2018 tax bill, it's only deductible up to $10,000, okay? And so as a result, you have this very small amount that's deductible for regular tax purposes, but it was never deductible for AMT purposes either, right? So same with property taxes, you know, capped to $10,000 for along with state income tax for regular tax, but not deductible for AMT purposes. And then really kind of the only other kind of major item is that when you exercise and hold ISOs, then you have income for AMT purposes, but not for regular tax. But I would say in just about every other situation, and most income items, whether they be capital gains or they be wages, they're both taxable for regular tax purposes and for AMT. But as I noted earlier, the big difference is that, you know, for regular tax purposes, they have a progressive tax rate structure, which means that the more income you have, the higher the tax rate. AMT is just a flat 28% rate on their income. So.
Ray, can I just explain this? Can I just add in like layman's terms that my understanding of the AMT, when AMT kicks in is when you are not paying enough tax in IRS eyes, right?
You know, when you talk about the history of AMT and why it came into place, yeah, that's correct. Because what happened was a lot of people would be allowed to take all these deductions, and they could have large gross income, but because of all these deductions, they weren't paying any tax. So about 50 years ago, you know, Congress said we have to do something about this. So they said, okay, well, you have this regular tax system where you get these deductions, and then for AMT purposes, you then say, you know, you don't get this deduction, you don't get that deduction, right? And so that's really kind of how AMT started. Now it's to the point where there's really they've gotten rid of a bunch of deductions at the regular tax level as well, right? So that goes back to my comment in terms of that, you know, more likely than not, someone's actually going to be out of AMT because of these new rules. That's because state, you know, so, you know, prior to 2018, you used to be able to deduct state income taxes in full, right? And so if someone had $10 million of income, their state income taxes on that might be over $1 million. They would get that as a deduction for regular tax purposes, but not AMT. Well, starting in 2018, their deduction is limited, or state income tax deduction is limited to $10,000, right? So they're not getting much of a benefit at the regular tax level as well. So I agree with your comment if we're talking about how AMT came into being into the first place, but there have been changes over the years, which has caused it to be more of a point where there's going to be very few situations where someone's actually subject to AMT.
Got it. Next question. Could you summarize some key highlights for people who are filing their own tax returns for 2020?
I would say what happened was, there's some, if someone has kind of like wage income, I would say, if someone wants to give a bunch of money to charity and they want to give it to, when you give money to charity, you can, let's say someone, is making $200,000 a year. Normally, if someone wants to give a bunch of money to charity, they might have to give, they might be limited in giving like up to a certain percentage of their income. It's either 50 or 60%. So let's say it's 60%. They can only give and deduct $120,000 in that case. But with the CARES Act for the 2020 tax year, they actually put in a law that said if you give cash to a public charity, you can deduct up to 100% of your income. Now, I'm not necessarily expecting a bunch of people took advantage of that, but that's really kind of the only, kind of like meaningful change that we saw for 2020.
Okay, so let's see. Next question: if using TurboTax, normally one can just import forms from various brokerage firms. What should we watch out to make sure all profits are calculated correctly?
Yeah, I would just say that, I would spot check it. My understanding is TurboTax is pretty reliable when you're sort of uploading from, like E-Trade or something like that. But I would just kind of spot check it. Typically what happens is these like an E-Trade or a Vanguard, they'll be providing summaries. There might be a lot of trades, but they should provide summaries, and you should just be able to kind of spot check the summary, like the total gains and losses.
Okay, I have something to add on that. Our RSUs, I think even with E-Trade, the import data is actually not exactly accurate. You need to manually adjust your cost basis for the RSUs that you exercise. Is that true?
Well, first of all, in terms of terminology, you technically don't exercise RSUs. You just sort of vest in them. But you're right. Like you want to make sure that if you had RSUs that were sold, you want to make sure that the cost basis, if you turned around and sold your RSU shares immediately after vesting, there really should be no very little gain or loss, right? Because if you take them into income at $10 a share and then turn around and sell them for $10, then you have no gain or loss. If you take them into income at $10 a share and then turn them around and sell them for $10.50, well, then you have a 50-cent gain there, right? But yeah, you want to make sure that the value that was used to tax as wages in your W-2 is also the value that they're using for your cost basis.
And that's normally something that I had to do it myself. Is it normal?
Not necessarily. I've seen situations where it was properly accounted for, so I wouldn't say all the time you have to do yourself.
Okay. Yeah, I guess this year when I do it, I'll pay particular attention because I always had to do it. Yeah. Okay. Next thing, let's see. When should I pay stock gain taxes? Which is a small amount, for example, $1,500 for 2020. Should I pay it as soon as possible or before April 15 with 1040?
I would say you're probably in a situation where you don't have to pay it until you file your return.
And is it just because the amount is not material?
Correct. You may have met your safe harbor estimated tax payment amount, through withholdings. So.
Okay. Let's see. Anybody else have questions? So feel free to ask. And then for, I guess. Yeah,
I just want to mention I have time. I have time for one more question.
Oh, okay. Okay. Yeah. I think we have another 20 minutes, another scheduled 20 minutes, and feel free to drop off if you need to, right? I guess okay. So I'll take that chance for the last question. What are the main mistakes and misses that people have, some of your customers have, that you would like to warn us on, so that we don't make the same mistakes on our tax returns?
Yeah, I would say this. One thing to keep in mind is, with stock options, I talked about how you do a same-day sale. Remember, if you do a same-day sale with non-qualified stock options, or even maybe ISOs as well, there's two events, right? One is sort of the exercise, and then the second one is the sale, right? So the tax event for the exercise will be recognized as income in your W-2, okay? Now, let's say your exercise price was $1 and the sales price was $10, right? So you're going to recognize $9 of income on your W-2 per share, right? But then you also sold that share. So you want to make sure to then report on your capital gains schedule that you sold for $10 a share. Now your cost basis in that example is $10 a share. So you have no gain or loss, right? But you want to just at least report that, because what's going to happen, I've seen this happen several times, is that the IRS is going to see the sales portion of it, and they're going to expect you to report that on the capital gains schedule, and they don't see it. So they might send you a notice, say, hey, where is this? I mean, the bottom line is you have full basis. There's no gain or loss to it, but it's just a matter of reporting the correct information to them.
Well, if you don't have gain or losses, how do you report that?
Well, my point is that, you report the sales proceeds and you report the basis that results in zero gain or loss. Because the problem is that the IRS will see the sales proceeds. They don't know that you have full cost basis. You have to tell them that you have full cost basis.
Well, that information does not come through the E-Trade import automatically? In
some cases, no. Yeah, in some cases it doesn't get reported properly.
Okay. Yeah, I guess that's the hurdle that I always have when I do my own when I do my tax return. So yeah, thanks for that reminder. And do you have time for a follow-up question on this?
Yeah, one more.
Okay, so I guess my I don't have the right terminologies, but then some of my colleagues who have been with the company for a long time, they have options that they can exercise. And what they do, what supposedly to happen is that when they exercise the options, and then they hold it for a year to sell, then supposedly that that sale is long-term, right? But then I think a lot of times when they even exercise the options, they need to pay taxes on the portion that they on the price that they actually exercise. That's the part that always confused me. Do you know what I'm talking about?
Yeah, we covered it in the presentation, and the issue is that if we're talking about non-quals and the strike price is $1 and the current fair market value is $5, and you say I want to exercise and hold this, well, you're going to recognize $4 per share of wages, and you have to come up with the withholdings on that, right? But now your cost basis is $5. The reason you might do that is because the value goes from $5 to $25, right? And you get the appreciation of $20 per share at capital gains rates.
I think what I have heard is that in your example, if the the strike price is $1 and I exercise it when the market price is 5 and I sell it when it's 25, my understanding is that if I exercise that option at 5 and I hold it for more than a year and sell it at 25, then the entire $24, which is 25 minus 1, is long-term gain or loss. Is that right?
You're thinking about an incentive stock option. That's correct for an incentive stock option.
Okay.
I was talking about non-qualified stock option.
Okay, got it. So yeah, I think no more questions, and then that's all the time that you have. So okay. Thank you very much for today's presentation. A lot of audience have submitted their comments that this presentation is very informative, and they really enjoyed it. So okay, I just want to present them and show our appreciation. And I guess after the pandemic, I owe you and Haitang a big dinner or a big lunch. I know you guys have high, how do you say, the hourly rate when you charge customers, right? And today you are doing this for us for free. I really appreciate that.
I'm always up for dim sum. So
we have fantastic dim sum in Bay Area, so we'll definitely do that after the pandemic. So feel free to drop off, and then I'm going to close it up with Haitang.
Sounds good.
Yeah,
okay.
Thank you.
Thank you.
Enjoy enjoy the rest of the weekend.
Thank you. Okay, bye.
Okay, bye.
Goodbye.
海哥，你有没有什么要补充的呀？
好，我就说一句吧，就刚才说到那个常见的错误，还有一个我经常见到的错误就是说，就是那个 rental， 做那个 rental 那个property 的 reporting。Schedule E 的时候，我经常看到大家呢，有人忘了这个 enter depreciation， 这个是比较常见的错误。这个问题就是说，你是 miss 掉的话，就是IRS 还是即使你 miss 掉了 ，IRS 呢还是说你这个你 deduct 掉了，以后就是卖 rental property 的时候，你不是cost basis 要就是减少嘛，按照这个 depreciation 要把它减少，不管你是不是以前 take 了，它都要把你减少掉，所以说呢，大家一定要注意，要记得把它deduct 掉。
OK， 其实这个是一个new topic， 我刚才都忘了，我其实脑子里面晃了一下，但是又忘记了。其实 Ray 他不光是做 stock options，he is specialized in individual tax， right？
对，很多东西都做，个人呢，state trust 这些各方面有很多东西。对， okay. 那个他还有一个就是说，没有时间讲，就是 qualified small business stock。这个呢，就是说这些大家在 startup company 做的时候，有可能拿到这样的股票，这样的话就是说有很多税务的优惠啊。
OK， 那如果是这样的话，海哥你还有时间对吧？有时你刚才说的那个出租房的问题，我就问你一下。Let's see， so 如果是自住房，在过去5年里自己住满了2年，然后出租了3年。那么你在卖的时候，其实还是可以作为primary residence 来卖，然后呢realize 500K 的capital gain tax exempt，right？
对，这是可以的，对。
OK， 但是呢，你需要 prorate， 对吗？It's not entire 500K that's tax exempt. As soon as you started, as soon as you convert it into rental.
对，这个是要 prorate 一下，另外就还有一个 recapture，因为你一部分 depreciation 呢，就是说那一部分 gain 和因为 depreciation 造成的你 reduce tax basis，然后不是你的 gain 增加了嘛，那一部分呢还是 capital gain，还是 long-term capital gain，但是它的 tax rate 不一样，它是25%税率，不是20%。
OK，那如果是这种情形，我们用TurboTax 来报的时候，是不是你把就是说你这个房子过去5年里面有多长时间在出租，TurboTax 会 automatically 帮你convert and calculate， 还是说你自己要去 manually adjust something？
这个我不用 TurboTax，所以我不知道。但我想这个东西也不是说那么特别，就是说应该还是经常会遇到。所以说呢，我猜可能还是可以的。最起码就是说他可能要求你 upgrade premium 还是什么的，这样他可以更好的这个处理对。
OK， 我们倒是一直都是用 premium。那这样，另外一个问题，我们以前在tax group 里面讨论过的就是这个 trust， 对吧？我们有一次讨论，我忘了那个 number 是多少，好像是10万还是多少？就其中有一个 CPA 贴的是说，it's advisable that you should set up a trust if your asset is more than 100K。那我想说，那个 number 真的是太低了，但是呢。Set up trust 确实是一个比较好的practice, right? I have coworkers who have done that, but I think we had a discussion in the past that you were saying that if you want to how do you say bypass the new threshold or standard, the trust that you set up, it has to be 就是不可以撤销的，对不对？
对，has to be a completed gift，就是说是irrevocable trust。这样呢，你就是说是从 gift tax 角度来讲，你确实是 gift out，你不能拿回来了不是说像一般的大家这个 living trust 其实不是这样的，以后可以改主意，都可以改。那实际上就是从 gift tax 角度来讲，你还没有 gift out，你没有给这个 gift。
那我想我想这样讲，我想这样问一下，就是说，你对于我们的 audience 的 advice，what advice do you have about the setting up trust？
set up trust 就是对多数人来说，如果说你远远没有达到那个，因为现在那些人急着要这个。从这个 gift tax 角度来讲，就是 transfer out，是因为担心以后的 limit 会减少嘛，就是降到350万，然后但是夫妻俩的话，就是加起来就是700万这样的。如果说你的 asset 是超过那个的话，你觉得有点担心，这个其实是远远超过了，你不可能现在就把所有的 asset 都给你的这个放在 trust 里，对吧？你肯定自己还要留一些。所以说那些人就是说很有钱的，他担心这个 limit 对他有影响了，然后他就现在赶紧，用现在的这个 limit， 对吧？每一个人是11.6个 million 嘛，这样呢就是2000多万，赶紧用掉，至少超过700万，对吧？可以 transfer out，那种是一回事，那个就是 completed gift。一般的人呢，那是 living trust，living trust 它主要是 for legal reasons set it up， 这样就是以后呢 bypass 那个 probate， 对吧 ？go through court， 要人去世了以后，那你 go through probate 很麻烦的，要很长时间才能够给这个就是传给这个children 呢，还是什么别的亲戚什么的所以说一般是为了这个呢，其实。limit 无所谓但是就是说你基本上10万可能太少了一点，但基本上你说你有个超过100万还是多少100-200万了，我觉得你这种时候是肯定是应该去 set up 了，对。
那我想问一下说，一般人弄的这个遗嘱和 trust 的 main difference 是什么呢？因为你刚才讲到说，如果假如你没有 set up trust 的话，那可能我们就是讲一个 extreme case 哈，那孩子没成年，然后假如说出了车祸，然后父母不在了，那么海哥你在吗？
我在。
OK，lost the screen。我的问题就是讲说，我们就是knock on wood，我只是讲说，万一有什么事情发生，to 父母双方，那么有 trust 的有 trust 的情形呢，是说你的 asset 不用经过 probation，right， 就可以直接到孩子手上，是这样吗？那如果是 from this perspective，what's the difference between a will and a trust？ 我如果说，假如说我没有 set up trust， 但是呢，我有一个遗嘱，如果比如说我跟我先生都不在了，那么我的遗嘱立的是说我所有的asset 都 pass on to my son， 对吧？那设立一个遗嘱和设立一个 trust 的 difference 在哪里呢
？OK， 首先呢，我要说明一下，这个呢，我不是专业啊，我不是做个人的专业，当然我知道一些，我自己的事情也处理了一下。遗嘱嘛，当然你不立遗嘱的话，你说怎么分都搞不清楚，对吧？是这样一个问题，到时候你就亲戚啊什么的都会去争，对吧？是这样，所以说呢，这个然后呢，有了遗嘱以后呢，这个就是你就是要 go to court 要争了，对吧？你不像你至少有了遗嘱以后，你这个问题没有了，都说得很清楚给谁。给谁呢？这个 trust 呢，就是为了 bypass probate， 否则的话，你可能还是要 go through probate 那个 go through process。当然，你遗嘱说的很清楚的话，就是减少以后的纠纷，但是就是还是要 go through 一个这个程序吧，就是麻烦一些的程序。你要是又有遗嘱又有 trust 的话，那这个就这些东西都 avoid 了，对。
那所以你的 advice 就是说，如果家里面的 asset 还比较 material 的话，就是比较稳妥的办法就是 set up both will and trust， 是吗？
对。
OK， 那你们 firm 也做这个业务的，对吗？
这个是 legal 的，这应该是 lawyer 做这个事情，对。
OK，got it。那有一个问题 coming in 是。Does family foundation still serve as a good tool to shield asset resources from tax?
哎呀，好吧，我这个有点硬的头皮，因为我不是做个税的啊。
没关系，我们反正你不管怎么样，也比我们要专业嘛。你可以先就是说 from your perspective， 你可以给我们一些 general 的 advice， 然后如果说 audience 他们还需要更加 professional 的，就让他们去找瑞好了。因为这些问题，说实话，I would rather it came out when Ray was still online， 但是现在瑞不在了嘛，那你就先回答一下。就是抛砖引玉一下这样子，然后 audience 如果他们有就是 more 他们有 additional 就是 need additional help 的话，他们去找瑞就好了，这样好吗？
对，这个 private foundation， 反正我也见过，就是说他们是做我想想看这个我是见过，他当然就是说怎么说呢？这个你的 charitable deduction 呢 ，contribution 的 deduction 呢，可能有些限制，不是像那个public foundation 的 public charity 那么 favorable， 但是呢，还是有的，因为特别是一些很有钱的人，他 set up 以后，他这样呢 have control， 对吧？他愿意这个钱给谁就给谁，不是说你给一个 public charity 的话，你 you have no control。主要是这个好处，税务上呢没有这个 donate 给 public charity 啊，比如说红十字会啊那样，当然更从税的角度上更有利。我是见到过一些，对，但是这个我觉得各种不同的吧，就是说需要考虑到不只是税的问题，还要考虑到你最后你的 你的 goal 对吧？你是说你有什么样一个 goal， 而且另外可能还有几个不同的 option 考虑啊。
OK， 一个 follow up question just came to mind。其实我们最近在另外一个 WeChat group 里面，大家有在讨论这个 IUL。在我自己的group 里面，就是几个月以前也讨论过的。IUL， 其实我不好意思，我跟我先生有买。那我的理解是说，IUL 的这个就是 proceeds 是就是 tax free 的，对吗？
你是说那个life insurance 呀？
对啊，是是 tax free 的 ，right？OK， 那就是说IUL 怎么讲呢？就是 in general 是一个相对 wealthy family 的一个 tax shelter， 可以这样讲吗？
有啊，他们也确实有这个 wealthy individuals， 他们有这个是一个 tax planning tool 是有的，对。
OK, got it. 那next comment 呢是说就是我们刚才讨论到 will 和 trust 的 difference。这个听众的 comment 是说 will can be challenged, trust is minimal to challenge, and estate planner can be better to lay out your options。我觉得这个是一个蛮好的补充，不过跟你讲的也差不多，就是说will 除非你写的非常的 detail, right， 非常的就是 specific and detail， 可能就不太会被 challenge， 或者说你的亲戚啊什么的阿猫阿狗不会跳出来去争这个东西。但是trust 呢，就是相对来讲更保险一点，对吗？
你也可以这么说吧。一般来说呀，我觉得就trust， 但是就说你是这样的，你 trust 的话，你除非你把你所有的 asset 都放在 trust 里面，这个可能不太现实吧。就说你不可能说所有的东西都放进去。
为什么呢？我的 understanding， 我有一个 coworker， 他就是这样做的呀。他 set up 了一个 trust， 然后他把所有的 bank account everything moved under trust。
OK， 他那每次工资发下来就直接就进去了 everything。Yeah，
我具体的没有问他，但是他去年弄的，然后因为他有2次提到说要去银行嘛，他说要把那个银行的account 也要改到 trust 下面去这样子。
然后你的这个房子是我知道，我们也做了。然后你说你的买了车子什么东西全都这个好像我觉得 OK， 那你大概 extreme cases 可以吧？但是现实上好像就肯定还是有些东西不在 trust 里面嘛。你说你的房子的 title 也在 trust 下面吗？车子 sorry 车子不是说房子，那个随便什么物件
所以你的意思就是说，如果你put everything under trust 的话，是一个不太 practical 的一个做法，对吗？
我觉得是，就是当然那些别的东西小东西可能不是那么值钱，因为最大的就是房子和你的这个金融的资产，对吧？金融资产的话，一般比如说你 retirement account， 你可以把这个就是 beneficiary 对吧，都放上去，这个可以说得很清楚。一般的 financial account 大概也可以。我自己操作的时候，好像有的 account 也不太好改，我就懒得改了。但是就是说你反正2个吧，我觉得2个都做，就是说比较保险一些。
OK， 好，那我想说我们的时间也差不多了，然后也听众也没有new questions coming up， 然后那我们反正我们有那个 tax WeChat group 嘛，那听众如果有什么问题的话，就可以再去那个 tax group 里面问，然后就是again 海哥是Anderson Tax Silicon Valley office 的 managing partner. He specialized in business tax, and Ray, who is the presenter today, is specialized in individual tax. He is also a managing partner. So if you have any follow-up questions, or if you have a need for a professional service, feel free to either ask me or ask海哥 in the WeChat group, so they can provide you professional help. 海哥，你有什么do you have anything to add?
没有了，就感谢大家参加今天的活动啊，就是我们很高兴分享，然后这个 Ray 也很高兴今天给大家介绍这个 Staff Compensation。
应该是我们感谢你们呀，你们抽时间就是在周末给我们做这个讲座，而且瑞也是临危受命哈，本来是你另外一个同事，结果不过我觉得他讲的非常好，他讲的就是非常的 clear， 他的语速啊什么的都非常的好，那let's see， 我刚才有一个 point 是什么 point 来着？不太记得了，没关系。那反正就是说，谢谢海哥对我们武当社区一直以来的支持，和理解。那如果大家有什么需要的话，海哥可以提供给你就是公司税和个人税的帮助。然后呢，我再顺便提一句，海哥的太太是就是一个fund manager 哈，他是基金经理，现在自己在就是独立帮客人管理基金，那他的这个投资门槛是30万美金，然后过去的 average return 呢是大概30%。然后Helen 的commission 呢是你的 return 的20%这样子，那Helen 姐也给我们做过 presentation， 是我们武当投资理财平台的第2个讲座，teach us how to invest， 就是价值投资啦这样子。所以有兴趣的话可以去听一听，然后Helen 姐也在我们的投资理财群里面，如果大家有什么问题要问 Helen 姐，或者说就是需要 Helen 姐帮你理财的话，欢迎大家联系他们。那again 是说，如果你需要 Helen 姐就是给你做 service， 那么 feel free to contact Helen 姐，不然的话一般的 general question 不允许大家就是私家专家然后在那里问一些 general question， 浪费专家的时间哈，这个就是武当节是不能容忍的。那好，that's all for tonight. Thanks everybody for dialing in and stay until the last minute. Really appreciate you devoting your time. 然后呢，sorry， 最后一个 comment 是说，我们今天武当姐拉了一个阳光群哈，就是武当投资理财和阳光 AI 交易信号联办了一个群。那么这个群呢是因为我有一些群友已经在阳光群主的收费群里面跟着他的信号操作了一段时间，就是已经proof 这个信号呢确实是比较 valid， 然后比较准，可以帮大家赚钱。那武当姐呢以前是在这个阳光群里面的，但是呢因为武当姐自己不会用嘛，所以呢没有 realize 它的 value。那现在呢，因为大家都回来跟我讲说这个东西确实很准啊，这个东西你跟着它就是很容易，基本上是确保赚钱，只不过是赚多赚少的问题。当然这个听起来有点像传销哈，那所以这就是为什么我会建这样一个 group。 我建的这个 group 呢是免费的，不收钱，而且呢我建这个 group 的目的呢也不是说帮阳光群主去促销，我只是说提供一个平台给大家去学习和了解阳光交易信号，因为我自己也想学习。说实话现在的股市真的是上蹿下跳，然后呢就是股市里面的大神给出来的意见也不一样，有的是 全仓上，有的是觉得还比较乐观，有的人觉得应该清仓。那么这个AI 智能数据能够告诉我们什么呢？我是武当姐自己是很想学习的。那么武当姐从来的就是说做事方法就是说，如果我去学一个东西的话，我希望带着大家一起去学，这就是我今天建了这个群的初衷。那么我们明天呢会临时加一个阳光信号的讲座，教大家怎么样去用这个数据，用这个信号。那因为是临时加的嘛，加上明天是武当姐老公的生日哈，所以呢，我希望说稍微晚一点。还有另外一个原因是因为说明天的 presenter 有一个是在欧洲的一位群友。那么如果我们regular 时间5点钟的话，对于欧洲那边来讲太早了，所以再加上就是武当姐老公的生日，所以呢，我们明天的讲座是安排在美西的8点钟。对于美东的同事来讲可能会太晚了，但是没关系。如果你不能参加 live 讲座的话，我们都会有录音放在 YouTube 上。不过呢，我是希望大家如果可以的话，就是尽量加入，因为基本上你学到了那个信号，你星期一大早就可以去交易了，这样子早学早用早赚钱这样。again 我就 claim 一下，不管就是武当姐跟海哥也好，Ray 也好 ，Helen 也好，大家都是一个就是互帮互助的一个互相内推的平台这样子。所以呢，我跟就是海哥的 firm， 还有海哥的太太，还有阳光群主之间没有1分钱的经济来往，以前没有，以后也不会有。所以呢，我只是就是说本着一个社区服务的目的。什么资源好，我就把它拿来介绍给武当群友们，希望可以 benefit 武当群友们这样子。那明天的讲座，如果大家有时间参加的话就最好。如果没有的话，你们有其他的安排，或者说东部那边太晚 ，that's totally understandable. I will record it and put on the YouTube channel. 那好，就这样，谢谢啦thanks everybody. 好，谢谢海哥。疫情过去了请你跟瑞吃饭哈。
好，谢谢。
OK， 谢谢，拜拜。
OK，拜。